Welcome back to the Deep Dive, the Talk Tickers edition. Today we are plunging into the Q4 fiscal year 2025 earnings conference call for Amdocs, which dropped some major news after hours on November 11th.
Yeah, and this deep dive is, I think, really necessary because we're looking at a classic market paradox here.
How so?
While management laid out a solid quarter, they highlighted a successful strategic pivot, and they talked up this massive generative AI opportunity, and yet the stock crashed almost 8% the next day on really heavy volume.
That's the central tension we need to resolve. So our mission today is to unpack those financial results, dissect this dramatic pivot they're making toward GenAI, which is a high-stakes, expensive gamble.
A very expensive gamble.
And pinpoint the specific 4 guidance pressures that just convince the market to sell now and ask questions later. We really need to understand why those operational beats couldn't save the tape.
And to set the stage, you have to remember Amdocs' history. I mean, for years, they have been stuck in that dreaded 3 to 4% revenue growth band. This entire shift, the good news, the AI focus, the margin pain, it's all about breaking out of that historical baseline. That context is everything.
Okay, that's the baseline. So let's start with the immediate numbers for Q4. On the surface, I mean, the headline figures looked fine.
They did.
Non-GAAP EPS hit $1.83, just nudging past the 182 consensus. Revenue came in at $1.15 billion, also narrowly topping the $1.14 billion forecast. A solid beat, technically.
But you have to immediately apply a huge asterisk to that revenue figure.
Okay.
Because while they met consensus, the reported GAAP revenue was down a worrying 9% year over year. Management's entire narrative, their whole story rests on you ignoring that 9% drop and focusing on the pro forma constant currency metric.
The PCC metric.
Right, which showed 2.8% year-over-year growth.
Okay, so let's unpack that because it's the key to this whole strategic pivot. Why is that the number they want us to look at, even though the headline shrank?
Because the shrinking is intentional. Amdocs spent all of FY25 actively phasing out low-margin legacy businesses, these high-revenue, low-profit contracts.
Got it.
By using PCC, they're basically telling the market, look, we got rid of the bad, bulky stuff, and the remaining high-quality recurring business is still growing at a healthy clip.
So they're prioritizing the quality of revenue over the quantity. A cleaner, but for now smaller top line. But isn't shrinking your top line, even intentionally, just terrifying for growth investors?
It absolutely is, and it raises immediate skepticism, which is why they hammered the profitability story so hard. Management framed FY25 as a pivotal year for boosting margins, and, they really delivered on that.
They certainly did. The non-GAAP operating margin for Q4 soared to 21.6%. That's a huge 290 basis point jump year over year.
And for the full year, non-GAAP EPS grew 8.5%. So they are executing that margin story brilliantly.
And I guess that's supported by their shift into these longer-term contracts.
Exactly. Managed services revenue hit a record almost $3 billion for the full year. That's 66% of their total revenue now.
Wow, 2/3.
When 2/3 of your business is built on long-term, outcome-based contracts, that gives you incredible resilience and predictability.
That resilience shows up in their forward visibility too, right? The 12-month backlog increased to $4.19 billion. That's up over 3%.
And that's huge. That number represents about 90% of their FY26 revenue guidance. So a massive chunk of next year is already locked in.
And that stability lets them focus on the future growth engines.
Right, the fun stuff. Cloud-related activities are booming, double-digit growth, and now it's over 30% of total revenue. They've got major projects with TELUS and Lumen.
But the real kicker, and the reason for all the pain we're about to talk about, is the generative AI traction. They're finally converting these proof of concepts into real deployments. They cited deals with Telefnica Germany, Altus, EN UAE.
And the PLDT expansion in the Philippines is the marquee deal here. This is a massive multi-year deal where Amdocs is embedding their AMA's GenAI platform deep into PLDT's IT modernization. They are taking end-to-end accountability for transforming that entire business using AI. That is the future they are betting the farm on.
Okay, so before we get to the friction, let's just tie up the balance sheet. Free cash flow for FY25, strong. $645 million.
Or $735 if you exclude restructuring payments. Plus, they returned a lot to shareholders. $551 million in buybacks, and they proposed an 8% dividend hike.
So we have a company executing a successful shift, boosting margins, locking in contracts, accelerating GenAI. Sounds like a fantastic quarter.
It does.
So what does this all mean for the sell-off? Why the market panic?
Here's where it gets really interesting.
Despite all that operational strength, the stock just gets hammered. It drops almost 8%. And the disconnect came down entirely to the outlook, specifically the full year FY26 guidance.
The revenue guidance immediately scared people. They projected growth for next year at a very modest 1 to 5% in constant currency.
That's not much.
Not at all. And critically, management signaled that roughly half of that growth would come from acquisitions.
Oh.
Which implies organic growth is barely accelerating, maybe even slowing down from that historical baseline.
And the caution around one key client just amplified that fear, right? They explicitly called out lower discretionary spending at T-Mobile, a major customer, as a headwind.
That is an immediate red flag. It triggers customer concentration risk concerns. T-Mobile is a colossal client. So if they're tightening the purse strings on discretionary IT spend, the market immediately starts to wonder.
Is this just a T-Mobile thing, or is this the canary in the coal mine?
Exactly. Is this signaling broader CapEx caution across the entire telecom sector? The market reads that one comment as an industry-wide risk.
Adding to the confusion was the margin guidance. After all the successful efficiency gains, they guided for only, 20 basis points of margin expansion for FY26? Why so little?
This is the absolute crux of the entire investment thesis. They are making a massive, deliberate trade-off.
Okay.
They are intentionally accelerating R&D and go-to-market investments into their new generative AI platform, which they call the cognitive core.
The cognitive core, that's their future engine.
Right.
What exactly is it, and why is it worth stalling your margin expansion for a whole year?
Think of it as their unified AI-driven platform for telcos. It's designed to automate everything from customer interaction to network maintenance. The investment is massive because it's a necessary, painful step to secure their second major growth engine.
So you're just reinvesting everything.
Every dollar of expected efficiency gain is being funneled immediately into this GenAI sprint. They are accepting near-term margin stagnation to structurally break that 3 to 4% growth barrier long-term.
So they are sacrificing profitability in FY26 to fund the growth they hope hits in FY27 and beyond. It's a multi-year gamble.
It is. And then the final pressures came from below the operating line. The market was already nervous, and the EPS growth guidance of 4 to 8% was compressed by two external factors. First, the effective tax rate is going up significantly, 16 to 19%.
Why the sudden jump in taxes?
That's mostly the OECD's Pillar 2 initiative. It enforces a 15% global minimum corporate tax. Amdocs benefited from some favorable tax locations, and now that regulatory floor is kicking in, hitting their EPS projection directly.
And secondly, higher financing costs because of a lower cash balance as they fund all this AI investment.
So the tension is palpable. Management sees long-term strategic success. The market sees T-Mobile risk, intentional margin stagnation, and rising taxes hitting the bottom line right now.
And the result was the sell-off and the analyst downgrades. A classic Wall Street move.
Yeah.
Sell on the uncertainty no matter what.
Exactly.
Okay. Given this intense institutional negativity, the 4 times average volume spike is huge. How do we arbitrage this disconnect between the short-term panic and the long-term story?
This brings us to our "This is not financial advice" segment. The market is basically pricing Amdocs like a tired legacy grower with an expensive, risky AI hobby. And this short-sightedness creates an opportunity.
The outrageous but plausible trade idea, playing directly against that T-Mobile panic.
We are looking to arbitrage time. The play is to sell the short-term volatility, for instance. The front-month November $90 calls fell 56% after the call. That's peak fear.
Okay.
While you do that, you simultaneously establish a deep, long-dated position using highly leveraged, out-of-the-money call options expiring well into Q2 or Q3 of fiscal year 2027.
So you are entirely skipping the messy, painful FY26 guidance period.
Precisely. This trade is a direct bet that management's conviction in this cognitive core transition is correct. The rationale is simple. If these new AI-heavy deals like PLDT ramp up successfully in the back half of FY26 and start to show real growth acceleration beyond that 5% forecast by FY27, the market is going to re-rate this stock dramatically.
And if that happens, the current $77 price will look like a huge discount, and those long-dated, deep, out-of-the-money calls will provide explosive upside.
It's a multi-year catalyst trade. You're betting on the successful execution of the strategy to break that old growth baseline. The current price is essentially letting you fund their future growth initiatives for free.
A fascinating deep dive. So we saw strong fundamentals, a smart pivot, but that long-term vision was just completely overshadowed by near-term caution from a major client and, well, the intentional cost of this GenAI transition.
And the core investment question remains. Is the sell-off justified by short-term pressures that will keep the stock range-bound for a year? Or has the market completely overlooked the multi-year value being created by reinvesting every margin dollar into this cognitive core platform? That's what you have to weigh.
Thank you for tuning into this deep dive. We'll be back soon with more critical analysis.